Now let's talk about the change in the depreciation method. So I just want to give you a background. Whenever there's a change in depreciation method, it's a change in the accounting policy because selection of the depreciation method is an accounting policy which is dealt by IAS 8, which says that if there is any change in the accounting policy, that accounting treatment should be done retrospectively. Change should be made retrospectively as if the entity is applying the revised method since its inception. Now, I just want to frame an example, explain the entire concept through an example. Think about a property, plant, and equipment whose cost is $500,000. We don't have any salvage value, and the depreciation is 20% written down value method that the entity is following. So after the end of third year, they want to change from WDV to straight line method and assume that the total useful life of the asset is 5 year and the remaining useful life is 2 year without any salvage value. Now, how to account for the change in the depreciation method? We need to apply straight line method since the date of inception. At the year zero, from year zero, we need to apply straight line method. If we would have applied straight line method at the end of third year, the net book value would have been $200,000. How did I compute it? So suppose the cost is 500,000, there is no salvage value and the useful life is 5 year, which means the total amount of depreciation per year is $100,000. So $100,000 of depreciation here, $100,000 here, and $100,000 at the third year. So the total net book value should have been $200,000. However, the net book value right now is $256,000, which means in order to be in parity, we need to reduce the book value of the asset by $56,000. $56,000 we need to reduce the book value of the carrying amount of the asset. And similarly, we will start depreciating the asset at $100,000 so that the net book value at year 5 is 0. Now let's look into the journal entry that they need to pass. Suppose we have already closed the books of accounts. Here, the we have already closed the books of accounts. Now, how to change retrospective adjustments? Because I am changing 256,000 to 200,000 because of the retrospective impact. This change will be accounted within the opening retained earning balance. We will change the retained earning balance by reducing the retained earnings. The net entry would be look like this. The net entry of retained earnings 56,000 to PPE 56,000. We have reduced the property, plant, and equipment by 56,000. So this is what we call it as change in the accounting policy in respect of the method that we are applying, the depreciation method that we are applying.